Real estate versus stocks. Which one actually makes you more money? In this video, I am going to answer that question with real data. We will look at which one wins in the short term, which one wins in the long term, what factors actually determine your returns in both, and at the end, I will tell you exactly what the smartest investors do with their money. Let us get into it.
Let's go!
Chapter 1. What the data actually says. Let us start with the long-term picture, because that is where the debate usually gets settled. From 1992 to 2024, over 3 decades, the S&P 500 delivered an average annual return of 10.4%, including dividends reinvested. Over that same period, U.S. housing prices appreciated at an average of roughly 4.8% per year. That gap, 10.4 versus 4.8, is the core of the long-term debate. On paper, stocks win the long-term argument by a significant margin, but paper is not the whole story. Chapter 2. The Buffalo Effect and why location changes everything. Here is where real estate gets genuinely complicated. The national average of 4.8% per year tells you almost nothing useful about a specific property in a specific place. Because real estate returns are not determined by the market, they are determined by 3 things: location, price, and government policy. Take Buffalo, New York. Before the pandemic, Buffalo was one of the most affordable housing markets in the entire country. Then remote work happened. People from higher-cost cities discovered they could get more space for far less money in Buffalo while keeping their salaries. Demand surged, supply stayed tight. In June 2026, the average sale price of a home in Western New York was $346,591. In 2020, that same home would have cost roughly half that. Housing prices in Buffalo have risen nearly 100% since the start of the pandemic. According to Parkle Labs, that is the highest jump of any major metropolitan area in the country. And here is the number that makes real estate genuinely powerful compared to stocks. If you bought that Buffalo home in 2020 for $170,000, you only put down $34,000 as a 20% deposit. Your home is now worth around $340,000. You made $170,000 in gains on a $34,000 initial investment. That is a 500% return on the actual cash you put in, not on the total value of the home, on your down payment. That is the power of leverage in real estate. You get gains on the full value of the asset while only putting down a fraction of the price. Stocks do not give you that without taking on significant margin debt risk. Chapter 3. Short-term versus long-term. Who actually wins? Short-term, meaning 1 to 5 years, is where real estate gets its most compelling results. The Buffalo example is extreme, but it is not unique. Home prices across the U.S. rose 47% on average since 2020. A 47% gain on your total home value with only 20% of your own money at risk translates to a return on your actual cash that far exceeds what the stock market delivered in those same years. The leverage effect makes real estate extraordinarily powerful in the short to medium term when prices are rising. Long term, meaning 10 years or more, the picture shifts. Stocks, specifically broad index funds, have consistently outperformed real estate returns by a meaningful margin when you measure total return without leverage. The S&P 500 from 2000 to 2025 delivered 7.7% per year in nominal returns. The Case-Shiller National Home Price Index rose about 4.8% per year over roughly that same period. Without leverage, stocks win the long game. With leverage, real estate makes easily accessible through mortgages. The comparison becomes significantly more complex. A 20% down payment on a property that appreciates at 5% annually delivers a return on your actual cash outlay that can rival or exceed the stock market's long-term average, especially when you add rental income on top. Chapter 4. The real takeaway. Here is the honest answer to the question everyone asks. Neither wins definitively. They win in different conditions for different people at different stages. Real estate wins when location is right. When you buy before demand recognizes the area. When government policy supports the market, low interest rates, infrastructure investment, job growth in the region. When you hold long enough for leverage to amplify your returns and rental income to build alongside capital appreciation. Stocks win when you pick right or index broadly and hold long. When you are not carrying the costs of property, maintenance, insurance, vacancy risk. When you need liquidity. When you do not have a large enough capital base to make real estate leverage work in your favor. The smartest investors do not choose between them, they use both. Real estate for the leverage, the income, and the inflation hedge. Stocks for the liquidity, the growth, and the compounding. A portfolio that combines both has historically weathered economic cycles better than one that concentrates in either. The question is never stocks or real estate. The question is what combination makes sense for your timeline, your capital, and your willingness to manage the specific risks each one brings.